Joining us today, David Rolfe is Wedgewood Partners CIO. David, great to have you back. You know, you've got, you come right out and say it, that the Fed chair has at least already broken the stock market, in your view.
Yeah, I think they've broken the stock market. I think they've broken the bond market. Look what's going on in currency markets. Jim Grant has a great line, and I've used it in a couple client letters. I mean, the Fed in the past couple of monetary cycles, particularly this last one, as he says, the Fed has been both the arsonist and the fireman, and we're seeing the ramifications right now. Hopefully they don't break the economy and they don't break corporate earnings growth, but that's yet to be seen. But they've done enough damage in the stock market right now, that's for sure.
It doesn't sound like you have a lot of faith that they won't push us into an earnings recession.
Yeah, I think that's the next shoe to drop. The numbers aren't that bad right now. You look at global PMIs from where they were just a quarter ago, and about half of them and other leading indicators are pointing to some trouble ahead. It's always interesting when school's over with and we get back into the markets after September. This next earnings, historically, the third quarter earnings reports are our first look at the new year, as well as an opportunity for corporate America to kitchen sink the rest of the year. If the weight of the evidence is a little bit more negative than what folks assume today, I think that the next round is going to be earnings cuts and another leg down in the stock market.
Right. So with that in mind, why are you adding to names like Meta, like PayPal? You're obviously still very much a fan of FANG. And you say if you got good ideas, you should overweight them.
Yeah, I mean, that's our playbook that we've been doing now for over 30 years. We only own 20 stocks, and our top 10, Carl, typically represent about 65% of our portfolio. I mean, it's very focused. In past bear market, when the bottom would ultimately put in, typically our top 10 names would represent 70, maybe 75% of our portfolio. At bear market bottoms, diversification has already failed. Everything's cheap. That's where you really have to swing a fat bet. And when you look at the returns of PayPal, Meta, the others that we like in the tech sector, we've been adding to Taiwan Semi. I mean, PayPal's down 69% over the past 12 months. Meta's down 59%. TSM's down 35%. Even Alphabet is down 30%. But in the context of where we're at just right now, Carl, in our 20 stock portfolio, we've built a portfolio where our forward PE is the same as the S&P 500. However, we're getting about 50% more profitability in terms of return on equity and almost 60% more earnings growth versus the S&P 500. So when this thing turns, we hopefully have some sprinters as well as some marathoners in the portfolio, and that's been our long history. I mean, we have to grin and bear it right now, no pun intended, but we're braced for more downside.
Right. Do you think that return to a growth mentality, are you going to be getting people joining your club in 23, or are you patient enough to wait even beyond next year?
I hope it's 23. And the growth trade has been pretty darn crowded. It's thinned out a lot. I was looking at some market stats in the last 2 weeks. Almost in the past 10 trading days, we kept on seeing more and more new lows. Then over at the NASDAQ as well as the New York Stock Exchange, Friday alone, on those two combined areas, 2,300 new lows. That tells me that the selling isn't drying up, and I think this fear factor is really becoming in the forefront of everybody's minds in terms of that growth idea. If the Fed breaks the economy, if the Fed breaks corporate earnings growth, for those companies that can grow in that environment, they're probably going to maintain their multiple. And I think a lot of them, where the multiple is now, they're actually discounting a really bad 2023. So that's the way we're leaning, and we'll see how it plays out.